If you want to replace a paycheck, you have to understand what a paycheck really is. A paycheck is not just money, it is a system. You give your time, your energy, your attention, your body, and often the best hours of your life to someone else's machine. In return, that machine sends you income on a schedule. That is how most people live. They do not own a system that pays them. They are part of a system that pays them only while they keep showing up. And the mistake most people make is that they think financial freedom means having a large pile of money. It does not. A pile of money can disappear. A pile of money can be spent. A pile of money can be eroded by inflation. What matters is whether that money has been converted into assets that send income back to you without requiring you to trade your time for it. If you make $80,000 a year from your job and you want to stop depending on that job, then the principle is simple. You need roughly $80,000 a year from assets. That does not mean it happens quickly. It does not mean it happens easily. It does not mean you can buy one thing, wait a few months, and walk away from work forever. That is not how good systems work. Good systems require capital, they require discipline, they require sacrifice, they require understanding the difference between an asset that makes you feel rich and an asset that actually sends you cash. Most financial advisors will tell the ordinary person to put money into the S&P 500 and wait. That is not a bad idea. Broad ownership of productive companies has been one of the great wealth building machines of the modern world. I believe in owning diversified equities as part of a sensible system. But if the question is income, then you have to think differently. Growth is one thing, income is another. The value of an index fund may rise over time, but unless you sell pieces of it or receive distributions, it does not behave like a paycheck. A paycheck arrives, it pays the rent, it pays the mortgage, it buys groceries, it covers insurance, it lets you live. So if your goal is to replace your paycheck, you need to study the assets that can create ongoing cash flow. There are 5 of them I want you to think about. They are not equal. They do not have the same risk. They do not require the same effort. They do not fit every person, and they should not be treated like magic. They are tools. A wise person does not worship tools. A wise person understands what each tool does, where it works, where it fails, and how it fits into the larger machine. The simplest income asset is the one where you lend money to the United States government. That is what Treasury bonds are. You are not buying a company. You are not buying a building. You are not buying a story. You are lending money to the government, and in exchange, the government pays you interest. This is the most basic form of income investing. It is not exciting. It will not make you feel like a genius at a dinner party. It will not produce the dramatic stories that attract people to speculation, but it teaches a very important principle. Income begins with a claim. When you buy a treasury, your claim is on the government. The reason people treat that claim as relatively safe is that the government has taxpayers behind it and the Federal Reserve System behind the currency. If the United States government could not meet its obligations, the problem would be much bigger than the return on one treasury position. That does not mean there's no risk. It means the risk is different. The benefit is that the income can be steady. The interest can come in regularly. In many cases, the interest is not subject to state tax, which can make a difference compared with some bank interest. And if you use a treasury bond ETF that holds very short-term government debt, you can create a monthly income stream that is simple to understand. One example in the original framework is SCOV, an ETF that holds short-term treasury bills maturing in 3 months or less at the time described. It was paying around 4.7% annually with monthly distributions. That is the attraction. But the limitations matter just as much. When you put money into this kind of instrument, you are not investing primarily for growth. If you lend $100, the $100 does not become $200 simply because time passes. You receive interest on the $100. That is different from owning a business that grows its earnings, expands its market, and increases its value. Treasury income is more like the stable base layer of the system. It is designed to produce income with lower volatility, but the return is capped by the interest rate environment. If interest rates fall, that income can fall. If inflation is higher than your yield, your purchasing power can still be squeezed. And unlike a bank deposit, a Treasury ETF is not the same as an FDIC, insured account. It is backed by Treasury securities, but the structure is different. You have to understand what you own, how it pays, and what role it plays. That is the first principle. The safest looking income often gives you the least growth. That is not a defect, it is a trade-off. A person who wants to replace a paycheck needs to learn trade-offs because every income asset has them. If you want more income, you usually accept more volatility, more work, more complexity, or more business risk. The next step is dividend, paying ETFs. This is where the system becomes more interesting because now the cash flow is no longer coming from the government. It is coming from businesses. A business earns revenue. It pays expenses. If it is strong enough, it produces profit. Some businesses reinvest most of that profit into growth. Other businesses return part of that profit to shareholders through dividends. If you own a share of a dividend-paying company, you own a small claim on that company's profit distribution. That is a powerful idea. Instead of depending only on your labor, you begin to own pieces of enterprises that may send you money while other people run them, manage them, sell the products, negotiate the contracts, and handle the daily work. But the danger is concentration. If you buy one company because it pays a dividend, you are also accepting the risk of that one company. Maybe the company takes on too much debt. Maybe management makes poor decisions. Maybe the product loses relevance. Maybe the dividend gets cut. Maybe the business weakens and the stock price falls at the same time the income disappears. That is how people learn the wrong lesson about yield. A high payout can be attractive, but a high payout from a weak asset can be a trap. The income looks good until the asset underneath it starts to deteriorate. This is why dividend ETFs can be useful. Instead of trying to pick one company, you own a basket of dividend-paying companies. If one company weakens, the fund can adjust over time. It does not eliminate risk, but it reduces the risk that one bad business destroys your whole income plan. One category is dividend aristocrat exposure. A fund like Noble focuses on companies in the S&P 500 that have paid and increased dividends for at least 25 years. At the time described, it was paying a little over 2% annually. That is not a huge yield, but the important concept is the history of dividend discipline. Companies do not increase dividends for decades by accident. They usually have durability, cash flow, and a culture of returning capital. But there is a second category, broader high dividend exposure, a fund like SHD, which the original framework mentioned as a personal holding, offers exposure to high dividend-paying American companies. At the time described, it was paying around 4% annually. That higher yield can be more useful for someone building income. But again, the yield itself is not the whole question you have to ask. What assets are inside the fund? You have to ask whether the income is sustainable. You have to ask whether the companies can maintain and grow their payouts through different cycles. That is how you think like a system builder rather than a yield chaser. Then there is international dividend exposure. This matters because not all cash flow has to come from the United States. Some overseas companies operate in growing markets and may pay attractive dividends. Some of those countries may grow faster from a lower base. Some may offer yields that look better than domestic alternatives. Examples from the original framework included VIMI, a Vanguard fund focused on high dividend-paying international companies, and IDV, an iShares International Dividend Fund at the time described. VIMI was paying around 4% and IDV was paying around 5%. But international income comes with its own risks. Different countries have different political systems, currencies, regulations, tax rules, and economic vulnerabilities. A higher dividend is not automatically better if the currency weakens, if the country becomes unstable, or if the business environment deteriorates. So once again, you have a trade-off. More diversification can help you avoid depending on one country, but it introduces other kinds of uncertainty. Then you come to real estate ETFs, or REIT ETFs. A REIT is a real estate investment trust. It allows you to get exposure to real estate without buying the building yourself. Some REITs own physical properties like apartments, offices, hotels, or other real estate. Other REITs own mortgages or debt connected to real estate. That distinction matters. A fund like VNQ gives broad exposure to real estate REITs that own physical properties. At the time described, it was paying around 4% annually. A mortgage REIT ETF like REM was described as paying around 9.5%. But the original point was very important. The higher number is not free money. Mortgage REITs can be more volatile because the assets are different, the leverage can be different, and the sensitivity to rates can be different. This is where many people make the mistake that hurts them. They see 9% or 10% and compare it to 4% as if the higher number automatically wins. That is not investing. That is only arithmetic. Investing is understanding the thing underneath the number. If the asset underneath the yield is weak, unstable, or overly exposed to a bad cycle, then the yield can vanish and the principal can decline. Then the investor loses both the income and part of the capital. So the rule is simple. Do not make the dividend your only decision factor. Income matters, asset quality matters more. The best income assets are not just assets that pay today. They are assets that have a reasonable chance of paying tomorrow, and the year after that, and through hard environments. That brings us to the next level of difficulty, owning real property. This is more advanced because it is no longer as passive as buying an ETF. You are dealing with a real building, real tenants, real repairs, real insurance, real taxes, real vacancies, and real management decisions. But it is also powerful because real estate can create multiple forms of return at the same time. It can produce cash flow. It is a hard asset. You can see it, touch it, insure it, improve it, and rent it to someone who needs a place to live or operate. And it can offer significant tax advantages when handled properly with professional guidance. But real estate is also where people overestimate themselves. They hear stories about passive income. They imagine buying a house, collecting rent, and watching money arrive forever. That is the fantasy version. The real version requires numbers, discipline, and operational ability. Let us use the simple example from the source. Suppose you find a 3-bedroom, 2-bath property for $200,000. In some markets, that may sound impossible. In other markets, it may be realistic. The point is not the exact location. The point is the calculation. Suppose you can rent that property for $2,000 a month. That gives you $24,000 a year of potential rental income. But potential income is not profit. You still have expenses, you have property taxes, you have insurance, you have maintenance, toilets break, roofs age, heating systems fail, you have management fees, because if you want this to behave more like an investment and less like a second job, someone has to handle tenants. Repairs, calls, and coordination. You also have vacancy because tenants move out and there may be time before another tenant moves in. After subtracting all of those expenses, suppose the property produces $10,000 a year in net operating income. If you bought the property all cash for $200,000, that is a 5% return on the cash you put in. That may be acceptable to some people, it may not be acceptable to others. The original framework said a 7% cash return would be more attractive. That means that on a $200,000 investment, the target would be $14,000 a year. This is the part most beginners want to skip. They do not want to do the math, they want the story, they want the dream. They want the phrase passive income, but the math is the truth. The story is not. If the numbers do not work before you buy, enthusiasm will not make them work after you buy. A good investor knows the acquisition cost, the expected rent, the expense load, the vacancy assumption, the management cost, the maintenance reserve, and the cash return before making the purchase. Then comes the tax side. Real estate can be powerful because the tax code recognizes depreciation. A building gets older each year, and the owner can often use that depreciation as a deduction, even if the property may be holding its market value or appreciating. In the example, if the property cost $200,000 and $30,000 was allocated to land, then $170,000 was allocated to the building. Under basic depreciation, that could create more than $6,000 a year of deductions. That matters because the property might produce cash flow while the taxable income is reduced by depreciation and other ordinary and necessary business expenses. But this is exactly where you should not be casual. Tax rules are not slogans, they are rules. You need a good accountant, you need documentation, you need to separate real business expenses from personal spending. You need to understand what is allowed and what is not. The principle is that real estate can give you cash flow, a hard asset, and tax efficiency if you buy correctly and manage correctly, but if you buy badly, it can give you negative cash flow. Tenant problems, repair shocks, legal issues, and stress. That is the trade-off. Higher control can bring higher opportunity, but it also brings more responsibility. The next income asset is even more demanding. Business ownership. Most people understand employment. Few understand ownership. An employee receives a salary. That salary is an expense to the business. The owner receives what is left after the business earns revenue and pays expenses. That difference changes everything. If a business generates $1 million in revenue and has $600,000 of expenses, then it produces $400,000 of profit. That profit belongs to the owners, subject to the structure, taxes, reinvestment decisions, and any profit-sharing arrangements. This is why ownership can be one of the strongest paths to income. You are no longer selling hours only. You are building or buying a machine that can produce excess cash after paying the people and systems needed to operate. But it is also one of the hardest paths. There are two broad ways to get there. You can start a business or you can buy a business. Starting a business requires creation. You have to find a customer, solve a problem, build a product or service, create systems, hire people, manage cash, survive mistakes, and stay alive long enough to become durable. Buying a business can look easier because the machine already exists. It may already have customers, revenue, staff, and systems. But if you buy a small business, you may discover that the business depends heavily on the previous owner. If that owner leaves and the customers leave, you did not buy a machine, you bought a job with a price tag. That is why truly passive business ownership usually requires more capital. If you buy a very small business, you may have to work inside it. You may need to become the operator. You may need to improve it, stabilize it, and eventually replace yourself with management. Only then does it become more passive. The internet makes this sound too easy. People say, buy a car wash, buy a laundromat, buy a small service business, buy this, buy that. But the principle is always the same. A business is a system of people, customers, costs, processes, and risks. If you do not understand that system, the business will teach you through losses. The phrase, how hard could it possibly be, has humbled many people because business looks simple from the outside and becomes complex the moment you own it. That does not mean you should avoid it. It means you should respect it. Business ownership can produce extraordinary income. It can create control that public markets do not give you. It can allow you to influence revenue, expenses, marketing, hiring, products, and strategy, but that control is not free. It comes with responsibility. If you want business income without working in the business, you need either enough capital to buy a durable system with management already in place or enough skill to build a system that can eventually operate without you. That is why business ownership is not for everyone. For the right person, it can become the most powerful asset on the list. For the wrong person, It becomes an expensive lesson in overconfidence. The fifth asset is peer-to-peer lending, or more broadly, private credit. This is where you lend money directly or indirectly to people or businesses that need capital. They might need money to buy a rental property, they might need a personal loan, they might need short-term financing for a real estate project. In exchange, they pay you interest, the attraction is clear, the interest rates can be higher than what you receive from government bonds or many dividend assets in private credit markets. You may see rates such as 5%, 10%, 15%, or even 20% in certain situations. But again, high interest means someone is willing to pay a lot for capital that can be rational in some cases, such as real estate flippers using hard money loans, but it also means you must ask why the borrower is paying that much. If the risk is low, money is usually cheaper. If the interest is high, the risk is often higher too. So the key is collateral. If you lend money and the borrower defaults, what do you have? If the loan is backed by a real asset, such as real estate, you may have some path to recover part or all of your money. If it is unsecured, you may simply be relying on the borrower's ability and willingness to repay. That is a very different kind of risk. Private credit can create income from capital you already have, but it requires due diligence. You need to understand the platform, the borrower, the collateral, the legal documents, the default process, the fees, and the liquidity. Can you get your money back early? What happens if the borrower stops paying? Who services the loan? What rights do you have? How are you protected? If you cannot answer those questions, you do not own an income asset. You own uncertainty that happens to quote an interest rate. That is why this asset belongs near the advanced end of the spectrum. It can work, but it is not something to enter blindly. Now step back and look at the full system. Treasuries are the simplest, lower growth, relatively stable income, less operational work. Dividend ETFs give you business income in a diversified wrapper, more volatility, more market risk, but potential for stronger long-term total return. Real estate gives you direct ownership of a hard asset, cash flow, and tax advantages, but it requires operational discipline and careful underwriting. Business ownership gives you access to profits, control, and large upside, but it may demand skill, capital, time, and emotional resilience. Private credit can give you higher interest income, but it introduces borrower risk, collateral risk, platform risk, and liquidity risk. These are not random assets. They are a ladder. At the bottom, the system is simple and the return is usually lower. As you climb, the potential income can increase, but the responsibility increases too. That is how reality works. Most people want high income, low risk, no work, instant liquidity, tax advantages, and full control. That asset does not exist. If someone tells you it does, they are probably selling you something. A good investor is not searching for magic. A good investor is matching assets to goals, temperament, capital, time horizon, and ability. If you want to replace your paycheck, you do not need to master everything at once. You need to build a system first. Understand how much income you actually need. If your job pays $80,000, do you truly need $80,000 from investments to leave it? Maybe yes, maybe no. If your spending is lower, the number may be lower. If your expenses are higher, the number may be higher. The paycheck number is a starting point, not a law. Then understand how much capital each asset requires. At a 4% yield, $80,000 of income requires $2 million of capital. At a 5% yield, it requires $1.6 million. At a 7% yield, it requires around $1.14 million. But higher yield usually comes with higher complexity or risk. So the real question is not just how much income you want. The real question is what risks you are willing and able to carry to get that income. That is where principles matter. Do not chase yield without understanding the asset. Do not buy real estate without knowing the numbers. Do not buy a business because the internet made ownership sound easy. Do not lend money privately without knowing what happens if the borrower defaults. Do not depend on one income stream. If your entire goal is freedom, freedom requires redundancy in nature. Fragile systems depend on one input. Resilient systems have backups. A person who depends only on a job has one input. A person who depends only on one tenant has one input. A person who depends only on one business has one input. A person who builds multiple asset-based income streams has more resilience. That does not mean you scatter money everywhere without thinking. Diversification is not the same as confusion. A diversified system has logic. Each asset has a job. The treasury sleeve provides stability. The dividend sleeve provides liquid business income. The real estate sleeve provides hard asset cash flow. The business sleeve provides ownership upside. The private credit sleeve, if used, provides interest income with collateral discipline. You do not need every sleeve. You need the right system for you. The person who wants simplicity may prefer treasuries and dividend ETFs. The person who likes tangible assets and is willing to learn operations may prefer rental property. The person who has entrepreneurial skill may build or buy a business. The person who understands credit and collateral may explore private lending. But the common principle is the same: convert earned income into productive assets. Use those assets to create cash flow. Use the cash flow to buy more assets. Repeat the cycle until the assets support the life. This is not glamorous. It is not overnight. It is not a trick. It is a compounding machine. At first, the income feels small, a few dollars, then a few $100s, then a few $1,000s. Most people quit before the machine becomes meaningful because the early stage is boring. They want a dramatic leap. But the people who win usually respect the boring stage. They keep earning, they keep saving, they keep buying assets, they keep learning, they avoid blowing themselves up, and over time, something changes. The assets begin to matter, the income begins to reduce dependence on the job, the person begins to have choices. That is the real point. The goal is not laziness, the goal is choice. A job can be good, work can be meaningful, building can be fulfilling, but depending entirely on a job can make you fragile because the income is tied to your continued labor and someone else's decision. To keep paying you asset income changes the relationship. When your money works, your time becomes less trapped. When your assets produce cash, your decisions become less desperate. When you have multiple income streams, you do not have to react to every layoff rumor, every bad manager, every recession, every change in your industry with fear. You still have risk, you still have responsibility, but you have more options, and options are one of the most valuable things money can buy. So if I were thinking about replacing a paycheck, I would not start by asking which asset has the highest yield. I would start by asking what kind of machine I am building. Do I need stable monthly income? Do I need growth? Do I need liquidity? Do I have time to manage property? Do I have the temperament to own businesses? Do I understand credit risk? Do I have the discipline to keep buying even when progress feels slow? Because in the end, the asset is only part of the equation, the investor is the other part. A good asset in the hands of an undisciplined person can become a bad outcome. A simple asset in the hands of a disciplined person can become a strong foundation. This is why financial education matters. Institutions and systems profit when people do not understand money. If a person does not understand income, they remain dependent on wages. If they do not understand assets, they buy liabilities. If they do not understand risk, they chase returns and get hurt. If they do not understand taxes, they give away more than they need to. If they do not understand ownership, they spend their lives making owners wealthier, while never becoming one themselves. That does not mean the system is impossible to navigate. It means you must learn the rules. You must learn the mechanics. You must understand that money is not just something you earn, it is something you assign. Every dollar has a job. It can be spent, stored, wasted, or converted into an asset that may produce future income. That is the shift. Most people ask, what can I buy with this money? The investor asks, what can this money buy that will pay me later? That single question changes a life over time. Treasuries can pay interest. Dividend ETFs can distribute business profits. Real estate can collect rent. Businesses can produce owner earnings. Private credit can generate interest from borrowers. Each one has dangers. Each one has uses. Each one can be misunderstood, but together they teach one fundamental truth. You do not replace a paycheck by wishing for freedom. You replace it by building claims on cash flows, and the earlier you start building those claims, the more time the system has to work. A paycheck is active income. It stops when you stop. A well-built asset base is different. It can keep producing after you step away, not because life became easy, but because you spent years converting labor into ownership. That is the game. You earn from work. You save from discipline. You invest with understanding. You protect yourself from avoidable mistakes. You let time do the heavy lifting. Then one day, if the system is large enough, the income from assets can stand beside the paycheck, then it can cover a bill, then a mortgage, then a lifestyle. Eventually, if the numbers work and the risks are managed, it can replace the paycheck entirely. That is not fantasy, it is math. But like all math, it only works when the inputs are real. You cannot pretend expenses are lower than they are. You cannot pretend yields are guaranteed. You cannot pretend real estate is passive if you have no systems. You cannot pretend a business is an asset if it only works when you are exhausted inside it every day. You cannot pretend a high-interest loan is safe because the number is attractive. You have to deal with reality. And reality rewards the investor who respects risk. So start with the simplest principle. Do not try to become free by taking risks you do not understand. Start by understanding the income streams available to you. Study Treasuries, study dividend ETFs, study real estate numbers, study business ownership, study private credit, compare them honestly. Then choose the assets that fit your situation. If you need simplicity, do not force yourself into complicated deals. If you have no interest in tenants, do not buy a rental property just because someone told you real estate is the path to wealth. If you hate operations, do not buy a small business and pretend it will be passive. If you cannot evaluate collateral, do not lend money privately because the rate looks high. Your strategy must fit your nature. That is one of the most important principles in investing and in life. The best strategy for someone else may be the wrong strategy for you, but doing nothing is also a strategy. It is usually a bad one. If all of your income comes from labor and all of your savings sit idle while the cost of living rises, Then you are exposed to a different risk, the risk of never building the machine. So the balanced path is to act, but act intelligently. Start small if you must. Learn with small amounts before using large amounts. Keep records. Understand taxes. Use professionals where the rules are complex. Avoid leverage you do not understand. Avoid assets that require more skill than you currently have, and keep returning to the central question. Will this asset help me build reliable income without destroying the capital that creates it? If the answer is yes, study it deeper. If the answer is no, walk away. The purpose of money is not to impress people. The purpose of money is to give you the ability to live according to your principles. For some people, that means quitting a job. For others, it means staying in a job but knowing they do not have to. For others, it means helping family, taking care of health, supporting a community, or simply sleeping without financial panic. The assets are not the goal. The freedom is the goal, but freedom without a system is fragile. That is why the 5 assets matter. They are not magic tickets. They are building blocks, treasuries, dividend ETFs, real estate businesses, and private credit each show you a different way capital can work. Some are easier, some are harder, some are more stable, some can grow more, some require almost no effort after purchase. Some require serious skill. The right combination depends on who you are, what you know, how much capital you have, how much time you have, and how much risk you can survive. A good life is not built by copying someone else's portfolio. It is built by understanding the principles, then applying them to your own reality. And the principle here is clear. If you want to stop depending entirely on a paycheck, you must start buying or building assets that pay you. Not someday. Not when everything is perfect. Not after you feel completely ready. You start by learning. Then you start by allocating. Then you refine. The machine will not build itself, but if you build it patiently, carefully, and honestly, the day may come when your investments are no longer small side income. They become the income. They become the system that supports you. They become the reason you can choose how to spend your time. That is when money stops being only a reward for labor and becomes a tool for freedom. And that is the shift most people never make. They work for money their whole lives. The investor learns how to make money work back.